All right, perfect. Well, welcome everybody to October's market update here. Topic today is going to be zombie companies, but we're also joined by a special guest today. One of the managers that we utilize in many of our clients' portfolios are joining us today. We have with us on the call Fritz Folts. He's going to provide us a market update and how 3Edge works and what they do to help their clients, especially in terms of market volatility. But they're a very good tactical manager that we use. So if you have any questions throughout his presentation, my presentation, feel free to put them in the chat box. We'll be keeping an eye and monitoring that and then bringing any questions forward to answer at that time. So I'd just like to introduce Fritz Folts. He's the Chief Investment Strategist of 3Edge Asset Management. So Fritz, the time is yours.
All right, thank you, sir. Thank you, Brandon. Thank you very much. And pleasure to be with you here today. And thank you all very much for taking the time to listen. As Brandon said, I'm just going to give maybe a very brief overview of our philosophy and how we do what we do at 3Edge, and then a bit of our market outlook. So kick things off with something that is a quote from Mark Twain that we feel is appropriate because it touches on something that we find to be foundational, to be really a core belief of ours, and that is in terms of the way that we invest anyway, we would say that there are two times in life when you should not speculate. One is when you can't afford it, and two is when you can. So we are not speculators. It's not what we do. We are very focused on risk management, and I'll get into that as we go. So who is 3Edge? What do we do? So we would be described as a tactical multi-asset investment manager. Being tactical simply means that we're making changes to our portfolios as our outlook for the markets changes over time. We're not day trading, but we're adjusting the portfolio depending on our outlook. We manage approximately $1.6 billion. We are also not only tactical, but multi-asset. So we invest in stocks and bonds and real assets, and that would include commodities and gold and cash and currency. So we invest across many, many different asset classes, and we invest across geographies. We'll invest in the US, Europe, Asia, Far East, and the emerging markets. And as I said, we have a very strong risk management and capital preservation focus around all that we do. And our portfolio construction, how do we build portfolios? Well, we do that through index ETFs. So we have US equities. We would use perhaps an index for the S&P or NASDAQ or the NASDAQ. And so that's what we have, globally diversified portfolios of index ETFs. And that's how we do what we do. Now this chart here, this is just how I'm going to describe the two strategies that are available to advisors and that we've seen Oxford use. So we'll start from the top here. Again, we're seeking to minimize large declines in portfolios. And to do that, we have asset class ranges, okay? So if you look at the blue line across and the columns there, that's our 3Edge conservative strategy. And you can see that that strategy will always have the minimum of 6% or a maximum of 30% in the equity markets. And then in real assets, we'll have a minimum of 4, a maximum of 22. In fixed income, a minimum of 10, a maximum of 88. And then if you go down one line, that's our total return strategy. And there we'll have a wider range that will be a higher minimum at 13 and a higher maximum at 60. And the reason that we do this is that these are fairly wide asset class ranges. And there are other tactical managers out there, but they have fairly narrow ranges. And maybe they say, well, we're tactical. We'll either have between 45 and 55% of the portfolio in equities. But for our purposes, and particularly in times when it's important to take risk off the table, if you will, we want to be able to really ratchet down our exposure to equities. As you can see here, in conservative and total return, we can get down to 6 and 13%. And we've basically been at those minimums or close to them for this entire year, which has helped us hold up quite well. if you look at the last two bullet points, it'll describe a little bit of how oftentimes people will, advisors will use these strategies. So if you think about our conservative strategy, oftentimes that is a replacement or a substitute or a complement to a traditional bond portfolio. So because the conservative strategy has a lower targeted risk and a higher targeted return than the Bloomberg Aggregate Bond Index, which is a fairly standard index which represents bonds. And then the final bullet shows our 3-edge total return. And oftentimes that's a complement to a traditional 60-40 portfolio where a client might have 60% stocks, 40% bonds. And a simple way of thinking about it is, well, maybe you took 10% from your 60 and 10% from your 40, and now you have a strategy that's 50% stocks and 30% bond and 20% our total return. And by doing that, you're adding diversification because it's always diversified, and you're adding our capacity to dial back risk or dial it back up depending on our outlook. So it will help improve the risk management of the overall investable assets for a client. So that's just a little bit of an intro to the way that we create these portfolios and why we create them the way we do. This chart I find to be helpful. So we call this the seasons of the market chart. And inside the circle, you can see there's fall to the right, then on the bottom, winter, spring, summer at the top. And what we would say is that the market goes through cycles, the economy goes through cycles, and those cycles you can think of as corresponding to the cycles that we see in the seasons in nature. So if you start at the bottom of the chart, let's say you're in the winter season, which would be also a time in the economy where you would be in an economic downturn, right? And that happened, when we were hit by the pandemic in the early spring of 2020. The economy basically came to a screeching halt, and the stocks went down very rapidly, very dramatically, and that's a time period where the Federal Reserve and the central bank came in and lowered interest rates to zero and started buying assets onto their balance sheet. And so that's a good time to be holding bonds, and bonds did very, very well in that environment. And then what happens is, what we saw was the response by the Fed and response by the government sending out checks. It created a recovery, and we're moved up to the spring to the left, and we got an economic recovery. And that is a period of time when your equities start to do quite well. And so they sort of take over, and it's their time to shine, if you will. And we saw that. We saw equities do very well right through the last 8 months of 2020, all the way through 2021. But then you start to cycle up towards the top of the chart where you get into the summer. And then what happens to you is you start to have an overheated economy and an overheated and an overextended market, which we saw in the latter months of 2021. We saw inflation starting to rise, and everything was going up. Stocks were going up, bonds were going up, commodities were going up, real estate, everything was going up, and everything was getting overheated as we got into the summer, into the top of the chart, including inflation, which we never thought was going to be as transitory as the Federal Reserve did. And then what happens is, it's not necessarily this overheating that gets you in trouble. It's the reaction by the Fed as a central bank in having to address the inflation problem and tightening monetary policy and raising interest rates. And that starts to push you from the summer towards the fall, because ultimately, by increasing interest rates, by reducing the size of the balance sheet, they are going to extract demand from the economy, and they're going to slow the economy, and that's going to have an impact on your stocks, and they're going to not do as well as we shift over here to the right into a period of the slowing economy. And then what could happen, we haven't seen it yet, but it could, is you go into a recession and you end up back at the bottom of our chart in the wintertime. And so a couple reasons this is helpful. I think hopefully it helps to understand those cycles that the market goes through. But I think also you can take it to heart somewhat, because some days it feels like the market's never going to go back up again. Let's have a good day today and decent October. But it feels like the markets are going to zero, but they're not. They're going through a natural cycle. And so all we would say is certain asset classes do better depending on where you are in these seasons of the market. And so by having the capacity to shift our asset classes from stocks to bonds to real assets and have a wide range to do that, we feel that we can put our portfolios in a position to take advantage of wherever we may happen to be in the seasons of the market. I am going to do this. Okay, all right. There we go. So let me give you a quick update on our outlook for the market, and then I can take some questions if we still have time. So there are definitely some challenges out here and things to keep in mind. So here's one. So this is the Federal Reserve balance sheet, the blue line. And what we saw was actually starting after the great financial crisis. The Fed started to buy assets, because by buying assets, they're injecting liquidity into the financial system. And in fact, that's one phase. And we see it start to go up there around the 2009 mark, and that's the financial crisis. But then it really took off, exponentially grew as a result of the reaction to the pandemic, where the Fed just bought massive amounts of assets and grew their balance sheet. And interestingly, the Fed printed more reserves, because it's basically creating money out of thin air by doing this. They printed more reserves since the spring of 2020 than they did over their entire 107 years of existence before that. Now, the orange line is what the Fed is projecting they're going to do in order to try to normalize and bring the balance sheet back down. And that has real implications, because that is extracting liquidity from the financial system. And we know that during the pandemic, when they added liquidity, that liquidity didn't always go into the into the economy. It went to buying back stocks, and all these asset classes rose. And so the Fed would say, well, it's going to be okay. We're just going to do this gradually over time. We're just not so sure. We think this could be a problem because they're extracting liquidity, which can be a headwind for assets like stocks and bonds. So that's one thing to keep in mind. Another thing to keep in mind is, as we went, again, coming out of the financial crisis, and then after the coming out of the pandemic as well, we saw profit margins going up dramatically. Companies were making a lot of money, again, with the help of, first of all, people buying because of being in the pandemic, but also because there was interest rates were so low. And so the cost of capital was very, very low, and margins were very good. And so the thing about profit margins is, right now, they are near where they were right before the bear market before World War II. And they're not as high as they were right before the crash of 29, but they're maybe a little bit in the neighborhood. And the thing to remember about profit margins is they're very much mean reverting. They will eventually come back down to their long-term averages, which would reflect the growth of the economy. So in order for the stock market to keep going up from here, we're going to have to see those profit margins can keep going up. And that is going to be difficult to do now with the Fed, again, extracting liquidity from the financial system. And we're already seeing, obviously the large technology companies have really suffered this past week with earnings reports that were, not as strong as people had hoped, and forward guidance that was fairly weak. And so if that's to happen, that takes away a support for the equity markets. One thing that happened here, this chart shows the blue line is the price of the S&P 500, and the gray line is the earnings of the S&P 500, and the orange line is the sales. And particularly during coming out of the pandemic, what we saw was, well, stock prices went up dramatically. Now, if you look at the gray line, that also went up. So people would say, listen, earnings went up. And so it would make sense that stocks would go up too. Sales went up, earnings went up, so stocks will go up. The problem is that stocks went up 6 times more than sales or earnings in the period coming out of the pandemic. And that's just simply not sustainable. So unless we get a real boost to earnings, those stock prices have to come down. These charts, I think, are instructive and maybe they're just helpful when you think about where we are. And this is looking at bear markets and bear market rallies. And so here's an example of the bear market from March 2000 to October 2002. And over that period, the NASDAQ, over 636 days, or 2 years more or less, went down 80, almost 83%. But on its way down, it had a series of bear market rallies. We had a rally at 18, that was 18% or 28%, 50%. There was even a rally that went up 52%, over 52%, all during that period that the market eventually ended up down 82%. And those rallies are what happens is they tend to be strong enough to bring investors back into the market just in time for the market to go down. So it's not that people can predict bear market rallies, but it's just a good thing to keep in mind when you see the market start to rally back. Don't necessarily get, jump back in there because it could be a bear market rally in disguise. I'll do this one really quick, but this is after the financial crisis and the crash in the real estate market. We had in 1 year, the market went down, S&P was down 57%, but we can see again, these bear market rallies of up 12, up 7, up 18, up 24, but over that long extended period of time, the market ended up being down 57. So now let's take a look at where we are today. So this is the beginning of January through the end of the third quarter on November 30th. And you can see that the market has come down, but it bounces back by 6%, 11%, 7%, and then by 17% into mid-August. And we could very well be in the midst of another bear market rally here. And eventually, it's going to be the real thing. It's going to be a rally that's sustainable and a rally that lasts, and it goes right through its 200-day moving average, which is oftentimes a resistance level for stocks. And the economy will pick back up. But you just have to be very careful because a lot of times these are simply bear market rallies and they can't be sustained. So what we're looking at in terms of risks that are in the market, and we feel that there are more risks than normal, I guess I would say, currently in the market. And first and foremost is we have the Federal Reserve that, in our estimation, waited too long to try to normalize monetary policy and waited too long to begin raising interest rates to try to get inflation under control. And so they are behind now. They're trying to catch up. And to catch up, they're having to do these 0.75% increases, one after another, and try to get inflation down to slow the economy, to make it more expensive to buy houses, et cetera. The problem is what they do when they raise rates, it operates with a lag. It doesn't necessarily have an impact right away, but months in the future it does. So if you do a bunch of these all in a row, you might have done too many because the impact of them will be felt months into the future. So what the risk is that the Fed, because they're having to catch up and be so aggressive in tightening interest rates, down the road, something may break. For example, there is an enormous amount of corporate debt in the world, and you have some of those companies, and I think you're going to talk about, because you're talking about zombie companies here. If you have all of a sudden, you have companies that are fairly weak in terms of their balance sheet, they may have a lot of trouble when it comes to servicing the debt as interest rates rise. And so that would be the definition of something breaking that would really hurt the economy and could force us into a recession. The second risk we see is stagflation, where the Fed raises interest rates dramatically, but it doesn't reduce inflation. But what it could do is slow the growth of the economy. And this would be the scenario we had in the 70s, where we had high inflation, but we had slow growth. And that's a very painful period to be in, a stagflationary period. The risk to corporate earnings, and maybe we're starting to see that as of this week with the technology companies. The corporate debt bubble, which I already talked about, there's just a lot of debt out there right now. And so if interest rates rise too much, that could be problematic. That could cause the economy to really fall hard, and geopolitical uncertainty. So obvious one on that is Russia's invasion of Ukraine, which, threw the energy market in Europe into a real crisis. And now is, there's a war in Europe, and the United States is, although not directly involved, we're involved. And so this is definitely a risk. And then the last geopolitical uncertainty is what has recently happened in China, where they just had their national Communist Party assembly, and President Xi was elected to an unprecedented third term. And looks like the Chinese now are moving away from their definition of globalization, which would have been to be more friendly towards the market, a little bit more friendly, allowing people in China to, actually become wealthy. Not everyone, but some. They may very much now be more going back to more communist ideology, more government involvement, and more focused on national security interests, becoming more self-sufficient. And those could definitely have an impact on the markets, because China is the second largest economy in the world. So there are a lot of risks out there. So basically where we are right now as a firm, which we are at and have been at our minimums in terms of our equity holdings. And that has been the right call this year. We've been at our minimum all year long. We are down slightly in conservative, down slightly in our total return, but much, much less than the stock market or the bond market. And the problem is you had this double whammy, because you had the decline in the equity markets, and then you're supposed to have the bond market help you by protecting your assets. But as interest rates rose, we saw the value of the bonds also decline. And so by being at our minimum in equities, near our minimum in fixed income, and a little bit more overweight in cash, that has helped us preserve capital in what has been a very, very difficult market. So we don't like necessarily the equity markets. We don't like the fixed income markets per se. There are parts of the fixed income market we like, which is the very short duration fixed income. We also like TIPS, which are Treasury inflation protected securities, because those are actually paying you the rate of inflation, increasing your principal by the rate of inflation. So you're getting a nice pickup there because you have inflation at 8%. We hold more closer to our minimum in gold. This has been a tough time for gold because real interest rates have gone up, and commodities have also, we have some commodities, but near our minimum there too, just based on the fact that the risk of an economic slowdown, and particularly in China, because they're such huge buyers of commodities, that could be a headwind for the commodities well. So we're in a very conservative position for now. We do know that at some point we will get back into this market, but right now we need to see some confirmation, particularly that inflation is starting to come down, because those wages and also the rents and the housing, that's really difficult. So it's a difficult environment, but we won't be defensive forever. There will be a time when all our model research will indicate that it's time to get back invested. But for now and this year, and it's been fortunate that we have been that way, because we've done very, very well. Our clients are happy with the fact that we've helped preserve capital. So I'll just stop there. And again, thank you for the time. I will mention one thing. I know that Oxford Wealth, you folks have a YouTube channel, right, Brandon? So we also have a YouTube channel. So if you go to YouTube and look up 3Edge, almost every week we create a video, myself and the chief investment officer. We try to keep them to 10 minutes or less, talk a little bit about the market, and then we try to pick a topic of interest, or we hope is of interest for our clients. And those have been very, very well received. So if you'd like to watch those, please, feel free, and that's where you'll find them. So that's it for me. I will stop. Brandon, I'll thank you for giving me the time. I'll take the question if you want, whatever you like.
Yeah, let's jump into some questions that anybody has, and then I'll jump into my section. I'll go through that in about 5 or 10 minutes. Not a problem. But if anybody on the call right now has some questions for Fritz, and I would agree, what we're seeing out of 3Edge, out of their social media presence, and just how much that they're keeping in contact with their advisors and with clients, is kind of unheard of in that manager situation. And so it's very unique what you guys are doing. And I know we as advisors really appreciate that, because, you know, we like to be informed, and there's a lot of managers out there that just don't have the communication that you guys do. And having that weekly market update, you know, the view from 3Edge. And I can tell you, as advisors, we hear from 3Edge probably on a weekly basis some sort of communication via email. You know, if they make changes to their portfolios, they're letting us know, you know, what changes were made and why those changes were made. And so it's always good to, as an advisor, to have that information. So thank you guys at 3Edge for being as proactive as you guys are.
Sure. You're more than welcome. You're more than welcome. So I don't think we're getting any questions on the chat, which is fine. We could turn it over back to you, Brandon, and you can take it from there. And I will stop sharing my screen.
Will do. Real quick, we did have a question that came in.
Oh, sorry. Yeah, far away.
You know, are the Feds going to raise the rates again?
Yes. We're pretty confident that they're going to raise them in the next meeting is next week, November 1st and 2nd. So we'll get that announcement next Wednesday. We had the GDP report come out. I believe it was yesterday. The days all come together, but I believe it was yesterday. And a positive 2.6% reading on GDP. The last 2 quarter GDP numbers, as you know, were negative. And so this was a positive surprise. But, and so it certainly wasn't something that would stop the Fed, right? Because if it were negative again, and maybe dramatically negative, that would put the Fed in the position where they might say, oh, it looks like the economy is already slowing, so we can pivot, is the word that people like to use. So, you know, we can stop doing this. We feel that they feel that inflation is very important to get under control. And Jay Powell, beginning back when he spoke at Jackson Hole, has been committed to, we need to stop inflation. We will do whatever it takes. And so our opinion is they'll raise interest rates by another 75 basis points on Wednesday of next week. The next Fed meeting after that will be in December, and we think they will raise interest rates again, maybe not 75 basis points. What will happen is they will start to use the language. It's funny because it's called the Federal Open Market Committee, and sometimes people call it the Federal Open Mouth Committee, because it's not necessarily always policy action, but you'll hear them start to change the words that they use when they talk. And so I think it will be clear when they want investors to see the light at the end of the tunnel, if you will. But we don't feel we're there yet. We feel November, another 75 basis points. December, we feel they'll raise interest rates again, but maybe by 50 basis points. But again, the problem is they waited too long to start to do this. And so they don't have time on their side. And it's very difficult because the effects of all the things they're doing won't necessarily be fully felt for many, many months to come, and well into 2023.
Yeah, agreed. Great question, August. So perfect. So I'm going to jump in real quick, just to the zombie companies real quick. And we'll go ahead and I'll zoom through this pretty quick, because a lot of what Fritz touched on today, especially on like that last slide, touched on these. So basically what a zombie company is a company that financially isn't bringing enough money to survive long term, right? They stay alive by borrowing more money. They're scraping by meeting overheads, right? They're able to pay their wages to their employees, rents, and sometimes they're able to completely pay off their interest payments, but not always. And so what that means is they're not profitable enough to reinvest in the growth of the company. It's kind of a stagnant company when we think of stagflation, right? There's little to no growth happening. And so what type of companies are zombie companies? These can be companies that have been around for a long period of time that just no longer have a competitive edge or advantage over its peers. But sometimes these are newer startup companies. Think a lot of different biotech companies, right? There may be years and years where they're working on some type of vaccine, if you will, or some type of medication to help out. All it takes is one successful trial, and that company can shoot up and become very profitable. And when we look at this, the zombie companies are employing around 2.2 million people, right? So that's important to know, because going forward, we know that we're in a period of time where we're seeing an increase in zombie companies. And part of this was because interest rates have been so low over the last, many years, that we're finally starting to see the rise of interest in interest rates in the economy. And so companies were able to borrow money without having to worry about these large interest payments. And so they've been able to survive for a long time. Now, what do we see happen with inflation? When inflation and interest rates are high, how does it impact these companies? Right? With high inflation, we know that growth typically slows, and you're going to start to see the profit margins decrease, right? Because consumers are no longer buying or having the extra money to spend on a bunch of additional things here. And so inflation directly impacts these companies, but so do higher interest rates, right? When you're borrowing and loaning money at a low interest rate, you're able to make those payments off and it not be a problem. However, when those interest rates start to increase, right, that puts even bigger strain on those companies. So when demand decreases, right, because of high interest rates and high inflation, you're going to have less revenue for the firm, meaning, profit margins, all that decrease. And then borrowed money that has a low interest rate, now when they're rolling over that debt to these new higher interest rates, they're going to be much higher, and it makes it much more difficult for these loans to be paid off. And so you're going to see companies that their debt just continues to increase over time. And so what are the results of this? And what have we been seeing with some of these zombie companies is we're seeing a lot of companies start to lay employees off, right? The companies are going to do whatever they have to try to make sure that that profit margin or that their profits aren't too negative, because that could result in also bankruptcy or business closure. Business closure for zombie companies isn't necessarily a bad thing, because what these companies are doing is they're ultimately taking up capital that could be utilized for a newer up and coming business. And so it's a cycle that we see with these zombie companies. And we've had a period of time with interest rates being low that these zombie companies have been able to stick around and survive longer and longer. And that's kind of made the growth of the economy probably slow down a little bit, because they're not profitable companies and a lot of them aren't going anywhere. So some example of some car companies or some zombie companies that we've heard of recently in the market, Carvana. They had a good competitive advantage, a lot of things going on, but we know that there's been some issues with Carvana, the way things have been handled. But they have total liabilities of 7.75 billion and only a market cap of 7 billion. So we see that they're in quite a bit of debt. And with things going forward, we'll see what happens with Carvana. That doesn't mean that zombie companies are always going to remain zombie companies or go out of business. Some zombie companies actually turn into some good profitable companies down the road. And it doesn't mean that because you're not a zombie company now that you can't become one in the future, right? Because with these higher interest rates as well, there's a lot of companies that may have turned a small profit, but with these higher interest rates, that's going to start to drive them into a negative profit margin there. Another company, Peloton, just this year, they've cut over 5,200 jobs. When we look at their stock price, Peloton was an absolute winner during the pandemic. Everybody was locked up at home and, well, I need to work out. I need to kind of get my exercise in. So everybody was ordering these Peloton bikes, and their stock price surged up to around $171 during the 2020. Their current share price is less than $8 today, right? Because as life got back to normal, people are going back to the gym, right? Nobody wants to stay locked up inside their house as much anymore. And so Peloton has taken a very big hit, and we've heard them in the news. And then we look at a lot of the meme stocks, right? AMC, GameStop, Bed Bath & Beyond. A lot of these companies are being artificially inflated right now by investors, but there's really no reason for it. When you look at the balance sheets, they're not, turning really profitable. They don't have these business models that are going to be sustainable without making some changes. So who should invest in a zombie company? These companies are going to be very high risk companies. High risk, high reward. But a lot of times these zombie companies, once they enter that territory, a lot of times they end up phasing out. They're very speculative. So, I love how Fritz touched on that on his first slide. Do you know, is the company nearing the end of their lifespan, or have they yet to achieve their potential? We don't know. For instance, Moderna, they were around for quite a while, and they hit it big during COVID with their vaccine. And their stock price shot up to around $450, $500, and they're now back down in the 100, 120 range. So we see this with a lot of different companies. And so what do we look at instead of these zombie companies, which, depending on the different researches, they're saying that anywhere from 13 to 20% or so are zombie companies today. And so we see with the lowest profit margin, this chart is a good chart to look at. Those companies with the lowest profit margins are getting hit extremely hard in today's market, losing 50, 60, 70% of their profit margins, right, and growth there. And so we see the highest profit margin companies are actually the companies that are producing the best results in this economy. Now they're still down, but they're able to survive, and they have strong balance sheets and a lot of free cash flow that allows them to withstand these periods of markets. And so this is one of those things with zombie companies. It's not going to be an overnight, these companies are going to go out of business, right? But I think what we're going to see is over the next couple of years, and as Fritz touched on, into 2023, 2024, I think we're going to start to see a lot of these zombie companies, these low profit companies, start to go out of business because of these interest rate increases. They're not going to be able to continue to pay off their loans. So they're going to have to shut down, which leads to a lot of unemployment, right? A lot of people are going to be let go from their jobs, and a lot of that's going to lead to possibly a sustained recession, a period of time where, these companies, I would expect to say over the next 1 to 3 years, we're going to see a lot of companies, as long as interest rates maintain as high as they are, we're going to see a lot of companies that are going to be going out of business and impacting. So main thing here is just understand what you own. If you're able to lose, or if you have money that you really don't care about and you want to play that risk game, then some of these zombie companies could end up, being great companies that have some great returns. But on the flip side, they can also drop down to zero and you can lose all of your money. So here at Oxford Wealth Advisors, we always like to talk about high quality companies, high quality positions, and tactical management, which 3Edge offers, and they do a great job doing that. And so if you want, we have information on 3Edge. If you guys don't have them in your portfolio already, if you're questioning whether it's a good fit for you or not, reach out to us. We'd love to help you with that. I know Fritz talked about the 3Edge conservative being a bond replacement, and you mentioned AGG, which is down over 15% year to date. I believe the 3Edge conservative model, as of the end of September, was down less than just barely less than 5%. So they do a great job at minimizing. Is that correct, Fritz, on that?
Yeah.
Perfect. So, I mean, when they talk about their tactical approach and tactical nature, it's been working extremely well in these market environments. And so when you're outperforming your benchmark by 4 times, you know, that's absolutely amazing. That speaks to the quality of research and analysis that they do as well in preventing these losses. But other than that, that's all I really wanted to touch on with zombie companies. I wanted the main focus today to be on 3Edge and just how well that they've done in the current market situation, in reducing the downside capture and exposure. But you guys also do a great job with that equity ETF range. You're able to capture a lot of that upside growth potential when the markets do turn around. So we'll end it there. And if you guys have any further questions, feel free to write them in the chat at this time as well. I'm going to stop the recording, and you can also feel free to turn on your microphone and go ahead and ask some questions.